Imagine this. You wake up, check your bank account, and see that your mortgage payment just got cheaper. Sounds great, right? The Bank of Canada just slashed interest rates again. But before you celebrate, there's a lot more to the story. Lower rates means big changes for mortgages, loans, and even your savings. So what should you do next? Let's break it all down so you can stay ahead of the game. As of March 12, 2025, the Bank of Canada just dropped its key interest rate to 2.75%, a 25 basis cut from the previous 3%. That's the 7th consecutive rate cut since June 2024. But what does this really mean? How does it affect your mortgage, your savings, and even the economy at large? Stick around because we're breaking it all down in a way that actually makes sense. Why did the Bank of Canada cut interest rates? Let's start with the big question. Why is the Bank of Canada lowering rates in the first place? A rate cut doesn't just happen randomly. It's a strategic move to manage the economy, and this time there are 4 key reasons behind it. Number 1, economic uncertainty. If you've been paying attention to the news, you know that Canada's relationship with the US has been shaky lately. Trade tensions are rising, tariff threats are looming, and businesses are feeling the heat. For Canadian companies that rely on exports, this uncertainty makes it harder to plan for the future. When businesses get nervous, they stop investing, stop hiring, and cut back on spending, which can slow down the economy. The Bank of Canada's response: make borrowing cheaper. When businesses can access credit at lower interest rates, they're more likely to keep spending and investing even in uncertain times. Number 2, consumer and business confidence is falling. Ever heard of the phrase, when people feel rich, they spend more? The opposite is also true. When people don't feel financially secure, they cut back. Recent surveys show that consumer confidence is taking a nosedive. People are putting off big purchases, whether it's homes, cars, or even vacations, because they're unsure about what's coming next. Businesses too are feeling the pressure, scaling back on hiring and delaying expansion plans. By cutting interest rates, the Bank of Canada hopes to restore confidence. Lower rates means cheaper mortgages, cheaper business loans, and overall easier access to credit, which should encourage people to start spending again. Number 3, inflation control. Inflation is one of the biggest concerns in any central bank. The Bank of Canada aims to keep inflation close to its 2% target. Right now, inflation isn't out of control, but it's also not low enough to ignore. If the economy slows down too much, inflation could fall too low, which can be just as damaging as high inflation. A rate cut is a way to balance things out. It encourages spending and investment, which helps keep prices stable. Number 4, economic growth expectations. Despite the current uncertainty, the Bank of Canada is optimistic about the future. It's projecting GDP growth of 1.8% over the next 2 years. A lower interest rate environment is meant to help fuel growth. When borrowing is cheaper, companies invest more, consumers spend more, and the economy keeps moving forward. How does this interest rate cut affect you? Now here's the part that actually matters. How does this affect your wallet? Because let's be honest, all these numbers and projections don't mean much unless they actually impact your day-to-day life. Here's what you need to know. 1. Mortgage rates are likely to drop. If you own a home with a variable rate mortgage, this is good news. Most lenders base their prime rate on Bank of Canada's key interest rates. When the Bank of Canada lowers interest, banks usually follow suit, which means lower monthly mortgage payments for homeowners with variable rate loans. For those thinking about buying a home, this could also make mortgages more affordable. But before you rush to buy, keep in mind that housing prices might respond to this shift too, so always do your homework. 2. Borrowing costs go down. Need a personal loan, a business loan, a line of credit? Good news, it's about to get cheaper. Here's how it breaks down. Personal loans. If you're financing a car, renovating your home, or taking out a loan for any reason, your interest rate will likely be lower. Business loans. Lower rates means it's cheaper for businesses to borrow money to expand, hire employees, or invest in new equipment. Lines of credits. If you have a home equity line of credit or HELOC, your interest payments may drop, giving you more financial stability. However, keep in mind that not all loans will see the immediate rate cut. Some fixed rate products may take longer to adjust. Number 3, saving accounts may take a hit. Unfortunately, lower rates aren't great news for savers. Most banks adjust their savings account interest rates based on the Bank of Canada's key rate. That means high interest rate savings accounts may not be so high interest anymore. Guaranteed investment certificate rates could also drop, making them a less attractive option. For those looking to grow their money, it might be time to explore alternative investments like real estate, stocks, bonds, or ETFs, but be careful, the stocks have been falling recently. So, now that we've seen 7 straight rate cuts, what's next? The truth is, it depends. The Bank of Canada will continue monitoring inflation levels, employment rates, economic growth, global trade trends. If the economy needs more support, we could see even more rate cuts, but inflation starts rising again. The Bank of Canada may hit pause or even increase rates again. For now though, the takeaway is simple. In a low interest rate environment, and it's up to you to make most of it. What should you do now? Here's a quick recap. If you have a variable rate mortgage, expect lower payments. If you're planning to borrow money, now might be a good time. If you rely on saving interest, you might need to explore other investment options. Staying informed is key. The Bank of Canada's moves impact your finances, and knowing how to navigate them can save you thousands in the long run. That's it for today. Drop your thoughts in the comments. Do you think interest rates will keep falling or will they rise again? Thanks for watching.